Ailing Chinese property giant Evergrande has filed for bankruptcy protection in the United States. The company, which was once China's top property developer, has been struggling with more than $300 billion in liabilities since 2021. Evergrande's problems have come to symbolize the growing crisis in China's huge property sector, which accounts for a big chunk of the GDP in the world's second biggest economy. Experts have long worried that China's real estate crisis could spill over to the global economy. Natixis senior economist Gary Ng joins us from Hong Kong with more. Now, Gary, just how surprising was Evergrande's bankruptcy protection filing in New York?
Well, I think if you look at what happened to Evergrande, it is probably what is the drama has extended from 1 or 2 years ago. But what worried me the most is not really what happened only to Evergrande, but if you look at together with the other cases that we have recently, for example, the Country Garden and also the Zhongyong Trust missed payment towards the investors. I think this really shows that there's a deeper problem brewing within the property sector in China. And more importantly, if you look at the cases that we see right now, the major difference is that Evergrande may be considered as a highly leveraged player, and then it's not basically regulators do not like it so much because of this high leverage. However, if you look at Country Garden, actually it managed to meet all the regulatory requirement of the three red lines, was supposed to limit the liquidity access to some of the highly leveraged player. So now basically we're in a scenario that we start to see even the good player as perceived by regulators begin to fall. There is indeed a stronger and stronger pressure in the property sector right now.
So it does sound, of course, you make it sound like the real estate sector is in trouble in China. Will this spill over into the broader economy?
Well, I think indeed, if you consider how big the real estate sector in China nowadays and also the linkage effect towards other sector, it can actually form close to 1/3 of the GDP growth. And this is why when we start to see this decelerating home sales, which affect the consumer sentiment, that will have a negative spillover effect towards the whole supply chain and let alone the developers as well. So therefore, indeed, I do think there can be quite a severe spillover effect on consumer sentiment, developers itself, and increasingly maybe the financial sector too.
So 30% of GDP coming from the property sector. So how much of what we've seen from Evergrande and Country Garden, among others, could be linked to China's so-called shadow banking system?
Well, indeed, I think developers in China is quite well known for their high leverage. So in the past, the major sources of their funding can be the pre-sales funding, which they get from home buyers when they actually sell a home. But beyond that, because of the tighter regulations, then it's actually pushing them to the so-called shadow banking sector because you cannot sell home at the moment. It's very hard to raise funding from bonds, and also it's also hard to get money from banks as well, and therefore this really pushed them towards whatever channel that is available, even though it may be quite costly. So I think indeed from what we see recently in the trust industry, there is already a decline in the exposure in real estate within the trust industry itself, but it doesn't stop some of the trusts to continue to have quite a high exposure to real estate, because if you don't do that, how can you give a 20% plus yield to the investor to attract funding, right? So indeed, I do think that there is quite a strong linkages to some of this one with the high real estate exposure. Now it's really about whether China is able to isolate this risk in real estate within the financial sector versus some of the bad cases that we have seen recently.
I mean, buying homes in China has really been a way of investing in something secure for a lot of ordinary Chinese people. And we've seen protests against the shadow banking system. Could this lead to broader instability?
Well, I think indeed because of what you have correctly pointed out on stability, I think it's very hard for the Chinese government to actually allow this risk to actually further spill over. But of course, on the one hand, we start to see this growing pressure in the property sector. And if we continue to see this liquidity problem in a lot of developers, then it's possible to see more default in financial product. I think that is for sure. But on the other hand, I also feel that compared to some of the other cases like the lost decade in Japan or what happened in the GFC in the US, actually the biggest advantage China has right now is still Chinese household has a very, very high saving rate. So it's not like in Japan or basically the US, the major risk actually lies in the household already because of their very high leverage. In China, actually households are not that high leverage. So I think eventually there can be a way out to mitigate the risk, but of course it depends on how costly it will be.
Now, local government financing vehicles are said to have a debt of more than $8 trillion. How much of a risk of a banking crisis is there in China right now?
Yes, indeed. If you want to link the real estate sector to the banking sector, I would be more worried about this potential exposure to LGFV rather than developers of mortgages. Because if we look at exposure of real estate of banks, I mean, they only have 3% of the access towards developers directly, another 11% to mortgages. But you can imagine that like 3% is not a lot, and then it's not likely that all the household will default on all the mortgage. So therefore, it goes to that 15% of LGFV that we are now talking about. So I think the major problem is that if we begin to see this decelerating home sales continue and it become like a persisting trend, then where do all this local government financing vehicle and also the local governments themselves manage to get the funding support to support all this cash flow in repayment, right? So I think for me, this is really the biggest risk that China may be facing in the future. And for now, we start to see there are more measures from the central government trying to force the local government to actually recognize this LGFV, bring them back to the on-balance sheet, and then also try to swap it with a low interest rate. But I think it still take time for it to happen. And then I wouldn't be surprised if in the next 1 or 2 years that there may be some default of LGFV simply because if you look at some provinces in China, actually the fiscal situation is really not that great after COVID.
Now, China is grappling with deflation, it's grappling with, soaring youth unemployment, and of course, weak exports. Just what can Beijing do to improve the economic situation?
But indeed, I think if you think of the external trade perspective, I think it's very hard for China to add much because it's really like a global weakness in terms of the manufacturing sector. And it's not only China, but also if you look at Germany or actually US as well, I think everyone kind of face the same problem because of the generally high interest rate globally. However, domestically, I do think the biggest hurdle that China is facing right now is really on consumer and corporate investment because they're not too confident about the future. So even though we start to see more rate cut, more liquidity channeling into the economy, we do not see a very strong pickup in loan growth because their balance sheet, because the biggest policy that Beijing should have is really relax the regulations, roll back some of the measures that may not be too business friendly to actually basically reignite this like a growth in the private sector and also the biggest kind of the cure to the current confidence problem together with the support of fiscal and monetary policy.
So what would be the impact of a recession in China, the global impact of a recession in China?
Well, I think even though we start to see the deceleration in a lot of economic data in China nowadays, which pretty much point to a diverged picture, because on the one hand, we see there's a very strong pressure on manufacturing and also the property sector. I think that are very clear. On the other hand, there's also like a certain cyclical rebound in the services sector, even though it may not be big enough to offset the other pressure that existing in the economy. So I think for now, I think it's likely that Chinese demand will not be that great for the world, which basically means that China may not import as much from the world. And together with what we see in the commodity prices nowadays, everything seems to be falling because of the weaker global demand. So China will not be a savior. So I think this will be my biggest takeaway, is that I think investors will need to accept that China will not grow as quick as before. And from the policy front, there will not be like a helicopter money in terms of supporting the whole economy. So it's very hard for the world to solely rely on China for the external demand in the future. So I think in the short run, policy matters, but it's very hard to see a very strong rebound in growth, because there will not be a very big change in policy.
Gary Ng in Hong Kong, thank you for joining us.